Hi, I'm Rick Nicholson, and today I want to talk to you guys about financial accounting. I know financial accounting can seem something scary for some people, but it's imperative that you do it. When you look at your financial statements, you should be looking at a periodic statement of at least every single month. But before you get to the end of the month, there should be no surprises. There are ways to actually capture your revenues and your labor costs on a daily basis, which can then transfer over to a weekly and then a monthly. So when you get all your information to an accountant, there should be absolutely zero surprises. You should pretty much know where you're at in terms of your bottom line profit. But your financial statements just shows that what you were doing to track your costs were in fact correct. But here's some of the key points in a financial statement. First thing, when you look at your comparables, a monthly statement should be compared to the same month in the previous year. That way, when you're looking at a March time period, you know, okay, generally we get 3 snowstorms in the month. We got 3 this year. So generally your sales should match up. But at the same time, don't only compare it to the previous same period, also compare it year to date. So your year to date same period. So in my case, I had a restaurant that year end was October 31st. So we would look at our year to date numbers from November to say March 2015 versus November to March 2014. And then we could see if our sales were up and if our costs were down or our costs were up. Now, when you're looking at the financial statements, don't look just at the bottom line profit. Bottom line profit's great, but really it's a subjective number. There's too many other things that go into that financial statement that you don't know if profit is real or if it's maybe inflated one month and it's going to be decreased the next month. So what's a better number to look at is your comparables. So number one, look at your revenue. Break out your revenue as best as you can between food and liquor. And then look at it comparably. So are you up? Are you down? Are you sideways? But then when you go to your expense column, make sure all of your line items are detailed out. So traditionally, you should have a food cost line item, alcohol cost, labor cost. Break out your labor by service and kitchen and management. Any other payroll costs should have its own line. Your rent expense, any interest expense, if you own a building or if you have a loan, should be on its own line item as well. Your sanitizer expense, your water expense, your energy cost, and even a power bill. I know power generally runs into energy, but if you're running a restaurant with natural gas or propane, it's always nice to see what's going on with the natural gas and propane bills. I'll tell you a quick little story. We had a client who never broke out all of his expenses, and at the end of the year, it was like, oh, am I making money or am I losing money? Now, more importantly, he didn't know he was losing $40,000 a year. His urinals were flushing at a rate of every single minute, 24 hours a day, even though he was closed for 8 of those hours. Finally looked at his financial statements broken out. He saw a water bill of $40,000 and he thought that was good. When I showed him a comparable number in another restaurant was only $6,000, he freaked out. He was like, what? $34,000 went literally down the drain. Now that doesn't have to happen. He actually turned around and instituted a timing policy on his urinals to flush only 9 minutes. And I was like, 9 minutes? You're still doing it every 9 minutes when you're closed for 8 hours a day. Felt the cost from $40,000 to $23,000 was a huge savings. And what I try to tell him was, yeah, that's great, but you can still save another 17 easily if you just turn the urinals off overnight. Another client of ours actually had an energy problem with his natural gas bill, but he found out about it the first month. A bill came in and it said $3,000 for natural gas, but because he was checking his financial statements every month, he realized quite quickly that natural gas typically only ran $1,000 a month. So he knew that immediately there was a problem, and all it was a valve. The hot water tank was continuously running and hot water was again just going down the drain. But he was able to fix that in the first month and was able to save substantial amount of money. Didn't have to wait after 12 months and pissed away $36,000. So it's really important that you break out all of your expenses and you understand where the expenses are coming from. Now, there sometimes will be timing issues, but you need to look at your comparables. And when I say timing issues, let's say, for instance, if you had everything broken out on an individual basis and you saw your energy bill from one year to the other had gone up at least 10%, because that's the variance. Anything less than 10% is usually not worth really paying too much attention to. But if you have an energy bill typically that runs $500 a month, and on your financial statements the next month it says $1,000, you got to question that. That's a 100% increase. But in this case, if you actually went back a month and you noticed that the energy bill from the month prior was zero, now you know what's going on. It's just a double counting issue. So broken out over time, really energy hasn't moved around too much. But it's really important to check your financial statements for all the line items, review it against its variance on its year to date, and also on a month by month period. I know financial statements can be difficult, but they're so important, especially if you're trying to make at least 5% margin at the end of the day. And in 5 points, you don't got a lot around to play. You don't have a lot to play around with. So anyways, good luck. Thanks for listening today. Have a great day. Bye-bye.